Hello traders, this is John Kicklighter, Chief Strategist for DailyFX.com. Over the past 24 to 48 hours, I've been watching these Aussie-based pairs pretty closely because we've had some pretty significant technical setups and a few noteworthy breakouts. And in this price action, I have taken a trade, the Aussie yen to the short side, although it was taken well before we've seen this price action. But we also had a couple that I did not take, including the Aussie CAD. And a very good question came up because I was looking at the Aussie, I was in the Aussie into the downside, and I was looking at the Aussie CAD for a potential upside drive. And a question came to me from Joel, who asked, why don't I just go short CAD yen? Right? Now, why would we look at going short CAD yen? Well, because on one pair, one Aussie-based pair, I would be short the Aussie. On the other Aussie-based pair, I would be long the Aussie dollar. All right? And technically, if you put those together, they should negate each other out, and you would end up with the synthetic CAD yen short. All right? So he has a very valid question there. Now, I didn't take the Aussie CAD, to be clear, but I did like the technicals. I like the fundamentals behind it, and when we saw as a setup, you can see here, 8-hour chart for the Aussie CAD. We were in this rising wedge, came back, tested the bottom of that wedge floor, and started to make a move higher. Now, this still can provide us a very great break to the upside. And if we clear parity plus 50 or parity plus 80, this is a fantastic setup. All right, but even if I did take this trade, and I had it at the same time as my Aussie yen I took when it held right here on this triple top, also a trend line resistance hold. Even if I had these together, I would not use them to make a synthetic CAD yen short. All right, why? We'll look at that today. And we'll also take a look at the dollar Swiss, one of my top trades of the year. And this is under exactly the same kind of circumstances, and it will kind of argue the opposite of what I was looking at with these Aussie-based pairs. So in that Aussie CAD, Aussie yen setup, you can see the technical patterns look pretty good. All right, Aussie CAD, upside, nice channel hold, nice wedge hold. Didn't take it because I'd prefer to see the break to the upside, so that position wasn't actually on. But I still like the bearings that it has. The same is true with the Aussie yen. All right, this is more of a risk-sensitive currency pair, risk aversion. Even if it does not catch strong momentum, this is something that is still driving its way lower. All right, so together these look pretty good. But as Joel insinuated, if I had those two pairs together, the Aussie CAD going one way, long, and the Aussie yen going the other way, short, I would negate the Aussie's influence and ultimately end up with a CAD yen position. Now, for those that are not familiar, this is a reference to the triangular arbitrage, or we call it currency cross arbitrage or three-point arbitrage theory. All right. If we combine two currency pairs like the Aussie CAD and the Aussie yen, and we're on the opposite sides for the Australian dollar component, then we should ultimately end up with what is a synthetic CAD yen position. Now you can't tell here because they are so close, but when I make a CAD yen position out of those two pairs, you're essentially dead on with the actual market rate CAD yen. So they're one and the same essentially. I actually put this blue bar back here, and it pertains to this right hand axis, to show you how far they are off at any one time. So going all the way back to the beginning of 2011. The biggest differential between the synthetic and the actual market rate was 10 pips. All right. So somebody that's extremely industrious might be able to try to take advantage of that, but it's extremely difficult to do. So for all intents and purposes, we would have a CAD yen that, if we had the Aussie CAD to the upside, the Aussie yen to the downside, we would essentially have a CAD yen trade. It would trade like a CAD yen. All right, so I would have to ultimately look at the CAD yen chart to see where those two are going together. But is there a value in holding this market-based rate versus looking at the individual two and holding them together? All right, well, you could save a spread that you'd be paying for making two currency pairs versus the one for the CAD yen, but there is a value in just holding one, or sorry, in holding two. In holding two currency pairs, I have a choice, all right, that the Aussie CAD and the Aussie yen, two separate trades, I can get out of one leg and allow the other leg to run. I can book profit on one leg and let the other leg actually get some time to develop. So what I could ultimately see is maybe in the middle of the trade, one aspect of this, one side of this currency, one of these currency pairs, might be giving us some good momentum. The other one might be moving against me. So I can exit out of that one that's moving against me. Let's say the Aussie CAD try to start making a break to the downside, but the Aussie yen continue to roll lower with the Aussie sell-off. All right. Under those circumstances, I would love to stay in my Aussie yen trade, but I would definitely have to unwind any kind of Aussie CAD long that I had. All right. But in CAD yen, that would ultimately look like a position that has not changed. All right, we would have a sideways price action from the Aussie yen, or sorry, the CAD yen. So we wouldn't be able to see and take advantage of any change in the market. I would have to essentially get out of the CAD yen altogether, or just sit on it, wait for it to develop, and it might not go anywhere. All right. So as you can see, there is at some times a benefit in being both those pairs instead of just going for what they ultimately make as a synthetic. All right. So that was my thinking behind the two Aussie-based pairs and why I did not look to just go for a synthetic CAD yen position or go for an outright CAD yen position. Sorry, but this is a very similar argument as well to what I was looking at for the dollar Swiss. All right. I've explained this one at the end of last year as one of my top 2014 trades. It is still my top 2014 trade, and in fact, I just took a long position in this setup because I think it looks good. All right. Now, in terms of the dollar Swiss, you have the position that it tracks out. Now, one of the big considerations of this dollar Swiss is that I like what it has or what it reflects in the Euro USD and in the Euro Swiss. So once again, we can look at some of that triangle arbitrage and see what the influence is, and I can take advantage, all right, of that triangle arbitrage. But I'm using it more as a guideline for this dollar Swiss, and I'll tell you some of the benefits that it gives after we look at the relationship the dollar Swiss has to those two different currency pairs. So with the dollar Swiss versus the Euro USD, all right, they're two separate pairs, but as it happens, under most circumstances, the Euro and Swiss franc against third-party currencies are essentially interchangeable. All right. Now you can see that the euro is on one side of this pair and the Swiss franc is on the opposite side of this pairing. Now what happens if I put them on the same side? Let me flip this dollar Swiss upside down, and as you can see, the correlation is actually very, very quite good. Well, that's a good thing because when I look at the Euro USD, I have a currency pair that has come up to the very top of a long-term descending wedge pattern, or you can call it asymmetrical actually, and this is a height that was set back in 2008. All right, so this is not a small pattern. This is a very serious pattern, and I think that resistance is very substantial. Add to it a fundamental element where the euro capital inflows have been so extreme that it looks exceptionally speculative. And that puts it at a very big risk and jeopardy of seeing a reversal in outflows. And that can come with any kind of sign of volatility in the general financial markets. All right, so I do like the dollar's appeal over the euro in this circumstance. And that is one aspect that I can look at for the dollar Swiss and get a different feel, a different trade setup. All right, and I can use that relationship. But then I also have the Euro Swiss. All right, the Euro Swiss is very unique. The correlation, once again, here looks pretty good. But the Euro-Swiss is a very unique currency pair in that we know that the Swiss National Bank has put a floor at 120, and it is dead set in keeping that floor in place. So that puts an unnatural but very robust floor underneath this currency pair. This relationship to the dollar Swiss will add that element to the dollar Swiss. Okay. So when I look at the Euro Swiss as a synthetic and compare it to the dollar Swiss, once again, they are very, very close together. But I like this dollar Swiss much more because, one, it has the elements of the Euro USD. It's a little bit more volatile, right? Has some of that activity. But if we did have that volatility translate into a break to the upside on the Euro USD, I can help mitigate that risk a little bit because of the Euro Swiss. Its Euro Swiss would have the relationship the dollar Swiss has to the Euro Swiss would be that 120 floor. All right, so it has that support, but it also has better volatility. It's not like I'm trying to trade the really slow Euro Swiss. All right, so that combined gives me a very interesting setup. And the dollar Swiss, when I look at it from this technical setup, looks like a good overall pair, right? Because it has the elements in the relationships that we see between the dollar Swiss and the Euro Swiss, and the dollar Swiss and the euro dollar. All right. Now, when you're trading these cross currencies, think about the individual, the different pairs that can be made to come to that same setup. Think about the individual currencies and what they would lead to. Sometimes we choose a currency that might not be the best pairing. All right, there might be another better currency pairing because one currency is too strong, and it might counteract some of the gains of that currency we're paying attention to. All right, so think about these in a more open sense. Think about it in terms of the exchange rates that we are actually making, but also on an individual basis, and you can come to some very interesting conclusions about how these can work and what might work better. All right. Hopefully this helped you look at these markets a little bit differently, and especially the Aussie crosses and the Euro crosses, or the Swiss crosses, and maybe even triggered some light bulbs in your head for possible trade setups. All right. We'll do our weekend strategy video tomorrow. Until then, good luck trading out there.